Welcome to Dealer Driven, where the rubber meets the road to success. This episode sponsored by Kerrigan Advisors.
Kerrigan Advisors is auto retail's only exclusive sell-side advisor. We do not employ a brokerage model or have a listing service. Rather, our team actively manages each client's sale process from beginning to success. Other firms have conflicts, we have your interests.
Welcome to Dealer Driven. I'm Michael Hayes.
And I'm Cameron Wilson. Michael, 2025 was quite a year.
You got that right, Cameron.
Well, today we have our good friend and NADA Chief Economist Patrick Manzi joining us again to break down the numbers from quarter four and give us some perspective of how the industry as a whole performed in 2025.
That's right. He'll also let us know what he expects for the U.S. light vehicle market in the year ahead, as well as give us a preview of his economic outlook session at NADA show in just a couple of weeks, the first week of February.
All right, Michael, let's get started. Patrick, Happy New Year and welcome back to the show.
Happy New Year to you both. I'm so glad to be back. We were just chatting a little bit about the NADA show that's coming up in a few weeks. So I hope that anybody who is tuning into this podcast, I hope we'll see you in person in Las Vegas starting around February 3rd.
Yes, and you can come earlier if you want. Las Vegas has a lot going on, but that's... we have so much to get to today. Before we dive into the numbers, can you give our listeners a quick reminder of the key economic forces that went into play into a pretty volatile Q4, I would guess, wouldn't you say, Patrick, in 25?
Yeah, certainly. Let's see. September 30th was the end of the electric vehicle tax credits. And so all of our dealer members had a very busy month of September dealing with processing all of these battery electric vehicle sales. And there was a large fall off following the expiration of the tax credits as we moved into Q4. We hit an all-time record for battery electric vehicle market share as 11.8% at the end of September. And then by the end of December, we were back in the mid-fives for BEV market share. I think it bottomed out in November at 5.3, 5.4%. But in the absence of that $7,500 tax credit, we did see BEV sales slow dramatically. Just 1 point of perspective, Q4 was down from Q3 by about 1.5% in terms of total volume. BEV sales fell 21% from Q3 to Q4. So a big drop off there. That was probably the biggest story going on, but there were certainly other things happening there too.
Let's talk about some of the standout trends other than EVs that you saw in the light vehicle market over the last quarter.
With the passage of the One Big Beautiful Bill Act, there is a new provision for 100% bonus depreciation. And so I heard from a few of our dealers that towards the end of the year, they saw a lot of business owners coming into the store to try and buy one of the vehicles that qualifies for that. I think it's a gross vehicle weight rating above 6,000 pounds. So that's typically larger SUVs and pickups. And so that was certainly a boost, albeit a small one, at the end of the year for sales. And, the mix of the vehicles that were sold at the end of the year tended to be a little bit higher priced. More of that was customer demand driven. And we actually saw average transaction prices top $50,000 once again. That happened in September for the first time at the end of the EV tax credits. They fell below 50, but hit 50 again with push in sales in December.
So let's talk about inventory levels. That's a big thing to all of us here, because having the right vehicle at the right price at the right time leads to our success, as we've seen. So how did these shift throughout the year on the new side? And what's the story behind those changes? I guess new and used.
So we had about 2.8 million new vehicles on the ground when we started the year. Then, as we all remember, there were several tariff announcements throughout 2025. And this caused disruptions in production for certain automakers as they were sitting there trying to figure out, okay, maybe I need to move this model's production here, or my vehicle doesn't qualify for any exemptions. I'm going to be facing significant costs for tariffs. So they paused production a little bit during the middle of the year. Inventory fell to about 2.4, 2.5 million units in the middle of the summer, and then rose again going into the fall. Finally, we got back to about 2.6 million. So a little bit of ups and downs throughout the year. And, I believe part of it was some of the pause to decide on how you optimally originally produced for tariffs. But we are seeing here examples of, OEMs largely doing what they told us they would do, and that is be disciplined with their production. And I think that was one of the biggest things that held back inventory from growing further. And because the inventory didn't get too excessive, we didn't really see incentives start to run too much. Incentives as a percent of average incentive spending per unit as a share of that average transaction price were running about 6.5% at the end of the year. And just for some perspective, for the pandemic, that metric was about 10%. So there is still a little more room for OEMs to open up that incentive spend if production does exceed, the demand out there. But I think largely when we look forward to 26, we're going to see more of the same. The OEs are going to try to be disciplined with production. However, you may, there's always individual players here who want to chase market share or have some stale product, and they'll need to ramp up their incentive spend individually.
Yeah, we certainly have seen a mix between OEMs as far as the inventory balance. It's not even across the industry.
No. But I will say, looking at the end of the year, most OEMs were below 60 days supply, which was a thing I hadn't really seen since back in the chip shortage days. So generally, I think most of the automakers, with a few exceptions here, are going into 26 in a fairly good position with their inventory, and that should be good for our dealers.
Absolutely. So, Patrick, you already mentioned the massive fall off on EV sales after the tax credits were phased out at the end of September. But what notable changes have you seen in consumer demand for hybrids and traditional gas-powered vehicles in the last quarter?
With the end of EV tax credit, you also have to remember that a part of some of the legislation we saw earlier this year set the fines for not hitting your corporate average fuel economy targets to zero. You had the CARB waiver taken away, which, largely forced OEMs to build BEVs or build vehicles, not necessarily for demand, but to hit certain fuel, emissions targets. And we're looking next year at, what's going to happen with some of the EPA rules. And those may be, the stringency of those rules may be lowered, or maybe they even go away. So largely what all of these moves did was free up OEMs to produce more vehicles for current consumer demand. What do the consumers want right now? What's the hottest segment? It is conventional hybrid. That was up 27% year over year. I believe it's a high 12% market share, and that's up 3 to 4 percentage points of market share year over year. So the customer is really hot for hybrids. That's been a big story all year. And I think what you will see going forward into 26, I'm thinking of Stellantis here. V8s are coming back. There may be some certain powertrains from other OEMs that were slated to be discontinued as a result of emissions or fuel economy regulations. They get to live on and have a longer life going forward. And so I think that's going to be a strategy. Maybe we don't jump into EVs as quickly. We've certainly seen a lot of pullback or walking back of statements from OEMs about we're not going to necessarily be all in on EVs by 2030. This is going to take a lot longer. And in the interim, while they make these big shifts and until they can invest more in some maybe new powertrain options, I think what's going to happen with a lot of these folks is longer life cycles for some of these models. But as a fan of V8s, fan of gas cars, it's good news to me.
What do you see as the natural on the EVs there? That's a key thing. What do you see as the natural demand? Is it the 5% the last quarter, or is it 6 or 7%? Just for BEVs, we talk about hybrids obviously being bigger in that transition. You read all kinds of different thoughts here, depending on who's the author. Just curious what your thought is on natural demand, assuming there isn't some huge incentive that OEMs are coming out with. As of now, that doesn't appear like they come out with big ones. So
for the whole year, BEV market share was 7.7%, which was down about 1/10 of a percentage point. So we're about, let's call it 8% right now. I think by the end of the decade, we could support 10 to 12%. And that's mainly because there are models, even despite all the changes in policy, there are still a lot of new BEV models that are going to come online in the next 5 years or so. And, every car these OEMs build sells at a certain price, right? And so these cars are going to be out there, they're going to sell them, and they may have to turn on the incentive spigot themselves. But I think, 10 to 12% is not out of whack, especially as, we continue to see advances in in lowering charging times, or infrastructure slowly gets built out and people just get used to using them in their daily lives. I don't think that's too out of whack, but that's a far cry from the 35% we were going to be forced to be at in 5 years. So I think 10 to 12 is much more realistic.
Kerrigan Advisors is honored to be the leading sell-side advisor to auto dealers nationwide. Our professional and proven sale process has earned our clients over $9 billion. Our team is always available to be a confidential thought partner as you decide the future of your business.
Yeah, and I was actually looking at something recent. I think it was JD Power was saying that current BEV owners plan on buying another BEV. So as there's more of those in the marketplace, that'll hold that too. Thank you. So let's change issues here and go back to affordability, which is probably one that affects far more people than the EV thing. When you think about that, it's an issue for a bunch of people. You mentioned the $50,000 transaction price, and again, seeing an article recently, it's kind of a split market right now, right? It's either you can afford a new one or it's going to be something else. So what do you see then as pricing trends and monthly payments? We saw it in 2025, what happened, and how do you think that's going to bleed into 2026?
Yeah, so we're at December's average monthly payment, according to JD Power, $777. So it did grow fairly significantly throughout the year in line with transaction prices. And although average rates came down a little bit, it was maybe 30 basis points, 30, 40 basis points, not a ton of relief. And so what I think would be a pretty smart strategy from some of these OEs is to, on your more entry level products, some of these compact crossovers, I'm thinking about building for stock more base and maybe one step up trims, because I think that's where the customer is going to be at. I've seen a lot of reports. I believe it was Ford who was talking about, they put out some press releases recently talking about the strong increase in demand for their lower trim models. So I think you could apply that to most OEs, have something that, you can hit that sweet spot, maybe that $500 to $600 payment, because once you get to $700, $800, there are a lot fewer takers. People are really going to have to stretch to get there. But if you have something $500 to $600, I think, you will be very successful, with your business. And then, just generally, when we take a look into 26, I still have penciled maybe 2 rate cuts from the Fed. And that was kind of before this trouble that's being stirred up potentially, which I would advise against unless you have some very strong proof that there was something bad that happened. We don't want to stir the pot there because we don't want markets to react and not believe that they're setting policy for the right reasons. So all that's to say, this is a shock that could affect the path of interest rates, because even if the Fed makes a move on short-term rates, it might not have any effect on the longer-term rates, which is what auto loan rates are set to. So let's hope that this is a storm that blows over and we still see cuts from the Fed and we see auto loan rates come down. Now, I'm not talking, crazy declines in rates, but maybe 50 basis points, I think, is not out of the realm of possibility. And that could do a lot for, vehicle affordability. That's, several tens of dollars trimmed off a monthly payment right there. That's really what I'm thinking about. I think if you're still going to have wealthy customers going for these more expensive vehicles, but, for your main bread and butter customer, I think lower trims might be the way to go for 26.
That's a good tip. Looking ahead, what are some of the other, in addition to potential rate cuts, major tailwinds or headwinds that you're watching that could affect sales volume in 2026?
Tailwinds, certainly. The Congressional Budget Office estimates that the One Big Beautiful Bill is going to tack on about 0.9 of a percentage point to GDP. So we will have a boost to overall gross domestic product here in 26. We're also expecting a pretty hot tax return season because of the new tax laws. And generally, when we talk about tax return season, it's more for used vehicles, because it's the used vehicle customers who get those tax refunds typically, and they use that for their down payment. So that's still going to happen, but we might actually get a boost here in the new market as well from the favorable tax policies. Now, I think that's just going to be a short-lived boost. It's not going to be enough money to really support sales significantly throughout the year. We're also going to have that, 100% bonus depreciation that's likely to help with sales at the end of the year. And then headwinds, I mentioned, what's happening over at the Fed. Anything that would disrupt the path of lowering interest rates would, affect affordability. And then I'm kind of paying attention to the AI bubble. All of these investments in these AI firms have supported a very strong equities market, and people are feeling pretty good, but anything that causes a big shock to the stock market will disrupt the spending patterns of these wealthier consumers. And, just for some perspective here, let me use my little cheat sheet because I don't want to get this one wrong. We are talking about, buyers over $150,000, they represent 29% of all the new vehicles sold. And back in 2020, that was 18%. So, the biggest chunk of buyers are now households over $150,000. Not the biggest, but we have seen a big jump. Excuse me. I want to get that right. A big increase in the share of buyers over $150,000. So I'm nervous about things that could affect those buyers. For now, though, where I sit, nothing, there's really not that bad, but that is a risk that I see out there in the economy.
So what about, tariffs? I'm still unsure where tariffs are. It seems like they're changing all the time, but yeah, that's right. And it seems to be that, when you read things, that a lot of the OEMs haven't necessarily raised prices by what some of the tariffs would indicate they would have to. How is this affecting demand? And do you see the OEMs still keeping that part in check like they seem to have up to this point?
Just going off quotes from some executives that I've seen, I don't think they can do it forever. You can't absorb all these costs. At the end of the day, they are responsible to their shareholders, and these are for-profit businesses that need to turn a profit. So you are correct. We have not really seen a big increase in prices. I think transaction prices were up about 2.6% year over year. That's not crazy out of the ballpark. Certainly, I have seen cases of models that have greater than normal price increases going from 25 to 26. But generally, those are imported lower volume models coming from places that face higher tariffs. And so there's a little bit of that where they are actually increasing. It's still not the amount of the tariff, but they are targeting certain models, I think, where there might not be enough margin to absorb it. But from a general perspective, at least starting 26, we have not seen massive price increases. And then, when you think about the tariffs on imported autos and auto parts, well, that's kind of a different bucket here. And I've certainly heard from our dealers that, replacement part prices have gone up. You see it in the CPI data where motor vehicle maintenance and repair costs are up about 47% since the pandemic. Insurance costs are up 55%. And just to back that, motor vehicle maintenance repair was up almost 7% in November. It was up 5 to 6% in December. That's, I think, when you own a car, that's where you're going to experience, I think, the tariffs a little bit more is when you go take that vehicle in for service, just because it is harder to absorb the costs there, I believe, for the OEs. So that's kind of what's going on. I don't know when they're going to start really passing along the costs, but I think some of those costs may not necessarily show up to the consumer, but to some of our dealer members. Some of the games may be played by the OEs there, trying to capture some of that cost. And certainly, they may hold off on ramping up incentives or try to be more disciplined with their production as another way to try and capture some of that cost. So all that's to say, I don't know when they're going to pass along the cost, but I don't believe that this can last forever. So maybe it happens later this year, maybe even into 27.
If I may, real quickly, I think the issue is the fact that the affordability crisis, because so many of the imported cars that are affected by that are the least expensive cars. They're building offshore for a reason, So I think that's just going to aggravate the affordability side.
Yeah, and I would just think that, one of the consequences here is that we might not have these vehicles to purchase, right? Because the margins are so thin, they just may choose to not sell them here. And so that's certainly not great when we're very focused on affordability right now. Losing some entry-level models is not great for that entry-level buyer.
Patrick, that leads right into a good question about used vehicles then. What's your outlook for used vehicle pricing and availability in the months ahead with all the unaffordability potentially of new cars?
Well, the good news is we're past sort of that off-lease trough that I talked about a lot last year, and largely expect that, off-lease vehicles are going to be up a couple 100,000 units. I think there will be more inventory, so we'll have a little less pressure just from the lack of inventory, but there will be more customers there. So I think during tax return season, you can expect that normal seasonal bump. But beyond that, I think it's going to be probably a return to normal, seasonal changes in used vehicle pricing as the industry has kind of, settles into this new normal for 26. One thing I will say, though, about those off-lease vehicles is that this year and 27, a lot more of them are going to be BEVs, and battery electric vehicles depreciate much faster than an ICE or a hybrid car. And so I think that is an opportunity maybe for some metro area dealers out there, for that customer who's really concerned about the payment, but, they don't have a big commute. They don't have a lot of they have a place to charge. I think they're a very good candidate for one of these vehicles, and they are going to be dirt cheap. So it's a really good option, and there'll be more of them. And I think that trend continues, 27, 28, and 29 to a bigger share of those off lease will be BEV.
That's great, and thanks for sharing all that. What about some of the trends at the end of the year that surprised Patrick Manzi? What would they be? The things that you said, well, I didn't really expect that, or this trend is different than I was thinking.
My forecast at the start of the year was for 16.2 million new light vehicle sales. We had all of these tariffs announced, and I was with everybody else. I thought this was going to really hurt sales, and certainly the initial policies that were announced were pulled back a little bit, so they weren't as bad as initially expected. But I was surprised I'm just always surprised at the resiliency of the American consumer. We ended up hitting 16.2. So despite all of these challenges we saw in the industry, it didn't really dampen demand. Now, to be fair, we had a boost from pull ahead volume of customers trying to beat the tariffs and a boost in BEV sales. And I think the pull ahead volume back in April and May was almost 200,000 units. So we did have these little points in the year where we got some pull ahead demand. But still, I think with the hand the industry was dealt back in April and May, sales really held up well. And so that was the biggest surprise for me.
Rental car sales have picked up on the new side as well. So they're doing newer cars.
Patrick, finally, what's one key takeaway? We love to ask this. What's one key takeaway or piece of advice that you would offer our members as they gear up for 2026?
I mean, I'm just going to come back to the affordability thing. I think as much as you can, try to keep as many of those affordable options on your lot. I really do think there are going to be a lot of customers who are really searching for that. And if you have enough choice there, I think you have a really good shot at winning a lot of business in 26.
It's a great tip. And if they want to come hear you at show.
Absolutely. So on Thursday, February 5th, in the main part of the expo exhibit at the NADA live stage, come see myself along with Jeremy Robb and Mark Strand from Cox Automotive. We're going to be talking about all things, light vehicle market for 26. So it should be a very, fun and interesting discussion. And I hope to see all of you there.
Terrific. Well, thank you very, very much, Patrick, for all your insight today. It's great having you on the show, and we look forward to all of the extra insight we're going to get at the show. So we hope all of our listeners are able to be there as well.
Thank you all for having me.
Thank you, Patrick.
Thank you, Patrick. That's all the time we have for this episode. A huge thank you again to our friend and economist, Patrick Manzi. If you're enjoying the show, leave us a rating, a review, and tell a friend. Once again, I'm Michael Hayes.
And I'm Cameron Wilson. This has been Dealer Driven from NADA. Keep your dealership in drive, and we'll see you next time.